Eric Wiegand, so far we've seen a lot of positivity in the market since the Brexit. Stocks are higher, we've seen some successful IPO listings, but is it merited?
You know, July has been such a different month than June. June, we were confronted with Brexit. We had miserable labor figures that have subsequently been revised even further down. July has been a respite. Not only have we gotten good labor figures, retail sales, consumer price index, indicators of inflation, earnings season has gotten off, while it's still in its infancy, has gotten off to a good start. And post-Brexit, we've actually seen credit, particularly credit spreads on corporates and high yield, really contract. So that's certainly provided support for equities in this environment.
And can they keep it up?
We do think that the real tell here is going to be growth in the form of economic growth, as well as, and most importantly, earnings growth. To the extent that we've had, we're just about 18% of the way through earnings season at this point, but we've seen results being less bad. So they're exceeding an easy hurdle. If that maintains, we could certainly see the markets advance from here. But it will be somewhat challenged. We really do think that this is going to be a very choppy and volatile environment.
Well, so far it seems like the banks have been the big winners in earnings season. We saw Goldman beat, JP Morgan beat, Citigroup beat. So are the banks a good place to be? Because a lot of people say if we're going to have a rally, the financials got to lead.
It's a great point. They really have not participated. They're finally coming back. We're having a bit of a catch-up rally more broadly beyond the financials. We are seeing healthcare and technology participate as well, and they had lagged. Financials, again, it comes back to being a less bad scenario. There was great fear and apprehension coming into earnings season because of depressed interest rate environment, concerns over credit and credit quality. And certainly from the more multinational got benefit as far as fixed income, currency, and commodity trading was a big bolster. But consumer credit has continued to expand. Deposits have grown, so it's been a more fertile environment for them. But in order to break going forward and do better, we really need to see a constructive interest rate environment. The yield curve's very flat, which is certainly pressuring net interest margins, and any Fed activity would certainly be welcome.
Right, but if you have a Fed rate hike, let's say in September, that might help the banks, but would that squash the rest of the rally?
It would be very interesting. I think to a large extent, in order for the Fed to go in September, and we don't think that they will, there would have to be very strong indications that economic growth is sustainable, that we're continuing to see progress as far as the labor markets are concerned. So that would likely be, we believe it would actually be a fertile environment for the broader market, with the acknowledgement that growth is viable and that you're having a sector that is effectively 16% of the benchmark, finally in a position to participate.
Another thing which some people say might quell the rally is what's happening in the political sphere. So talk about the election as it relates to the market.
It's a very good point. July is an environment where it's just robust with data points. Not only do we get earnings, we've had the labor figures, but we have both conventions. We begin to see the formation of platforms, what the issues are, the naming of the number two running mates. To our way of thinking, it certainly puts August and September certainly in the camp where we're likely to see greater volatility. I think the headlines will more be dominated by news out of the campaigns, and that can very easily prove to be somewhat unsettling to investors.
All right, well, thanks a lot, Eric.
Thanks, Greg.
Thank you for watching The Street.